So here's the SPY, and I would kind of call this the fact that the bulls are fighting off a confirmation day. So there's a significant battle going on between the bulls and bears right at 420. And as we've talked about in the past, that makes sense because 420 was a level. If you looked at our last SPY update on YouTube, so if you're viewing live on YouTube, please go to our channel at Elliott Wave Options. You can see last week's SPY update that we posted, and we showed the thumbnail from when we talked about the market going up to 420 or 4,200 on the S&P. So that was the resistance on the way up. We did break above it, but on the way down, it makes sense that that becomes support. And so we bounced off of it back here on the 24th of January, went up, tested that high on the 9th of February, and we came back down. Now, the two things that I wanted to point out is here on the 8th of March, we closed below 420, but our subscribers are well aware that anytime you break a point of support resistance, moving averages, break out of a triangle, etc., one day is meaningless. There are a lot of head fakes in the market, and there's been a lot of head fakes lately, especially with this additional volatility, with the market staying above 30 for so many days in the VIX. Over 14 days, we've stayed above 30. Can't remember that. Can't remember that many days in a row, consecutive days where the VIX is traded over 30. Another close below 420, and I sent a note out to our subscribers, another close below 420, but will we get the confirmation day today to send us on our way down to 400 and the extension of the C wave on that zigzag pattern? Again, you can see all that on the last update on our YouTube channel, but nope, back above 420 we go today. And in addition to that, we broke above and closed above the 10-day moving average. You can see yesterday we hit it on the high, the 10-day moving average, even though we closed below 420. Today, we actually closed above the 10-day moving average. So does that mean the other scenario that I talked about? Because you can see this descending triangle pretty well formed here on the S&P. So all this back and forth here over the last week at 420 has kind of created this descending triangle pattern. And I mentioned a scenario where if we did break to the upside and all of a sudden everybody started thinking, that's it, the bottom's in, we're done, 420 was it, support held at 420, we're moving back to the upside, and everybody comes all back in, and then you get a flush out. We break 420, we go down to 400 or whatever level we go to, and everybody throws their hands up, throws their towels in, whatever, says, that's it, I give up. And that's the kind of cathartic sell-off that does create bottoms. We really haven't had that yet, even with the market trading the way it has, with the volatility it's had, with the VIX above 30 as many times as it has. We haven't really had just a cathartic washout, everybody getting out type of we don't have to have that, but it happens often. So I wouldn't be bringing it up if it wasn't something that occurred often enough to make it worthwhile to tell you about. That scenario, the longer we do this, becomes more and more viable. Now, the other side of it is we've been at 420 long enough now that people can probably start to feel that way already. That could have been what was going on today. People are thinking 420 was already the bottom, and we could still have that same kind of cathartic sell-off now that we've spent so much time at 420. So my point is, we don't have to have the bounce that I talked about last week in order to generate that same scenario where you break 420 and everybody just says, I've had enough. I have no idea when the market's ever going to go back to the upside, and everything turns so ultra bearish that the market rallies. So pretty interesting that we spent this much time at 420, but not surprising, again, because that was a prime level on the way up. It's going to be a significant level on the way back down. Look what's going on with interest rates. So we're back above 2% on the 10-year. And the question becomes, this is a bit of a dichotomy, isn't it? So interest rates are going back up. Does that mean that money is coming out of the bond market and going into the equities market? Or is it coming out, getting ready to go into the equities market? Very well could be, because I surmise that we had this big run. The Federal Reserve hasn't changed their mind. They're still going to raise rates. In fact, they're probably going to raise them even faster than we originally had talked about, because the inflationary numbers just keep getting worse and worse and worse. So they're going to go crazy on raising rates. And why did the TNX go down then? Why did the interest rates on the 10-year go down? Well, I think a bunch of money moved into the bond market. And so now, does that mean money's coming back out? Or did what was going into the bond market get there and it's parked and no new money is going into the bond market? So now that's allowing rates to rise. So that becomes the question. Are the people that wanted to get into bonds, they're done, that's it, and so now rates can rise back up? Or is it money coming out of bonds ready to go back into equities, and that's the bounce scenario? So that's one thing that we will learn in the very not too distant future. We didn't really have the triangle out of the Dow that we did out of the S&P, but you could argue and say, well, wait a minute, yeah, there's support there at 330, and then here's your line of lower highs. It is a triangle, but it's awfully vertical, and there's not as many touches, so it's not as well formed. And so if you looked at the Dow, you could say, oh, there's a breakout day, because it did break that line. Still, that's just one day, doesn't mean anything, right? If we have a big up day in the Dow tomorrow, so if we get confirmation, then perhaps the bounce scenario plays into being. Can the Qs catch a break here? I've mentioned numerous times that I just think it's going to be a rough year for the Qs, with the Federal Reserve raising rates, withdrawing liquidity. It doesn't mean we can't have rallies. In bear markets, you have really rip-roaring, rip your face off, as they say, rallies within bear markets. They happen all the time, but they don't last. They're short-lived. But you can have a monster rally and then it just sells right back down. That's what occurs in bear markets. We didn't really have that out of the Qs. In fact, if we look at the moving averages, we didn't even get back above. We didn't even trade above the 10-day moving average on the Qs today, let alone close above the 10-day moving average. So all we did was kind of rectify a slightly oversold condition on the close yesterday. So you look at that, I still maintain that even though there'll be some bounces along the way, that's a pretty nice 5-wave impulse pattern to the downside, LA wave impulse pattern to the downside with a 38.2% wave 4 correction, nice fib level there. So we do have some support there at 320, which is, is a fib level. If you looked at the markets last week or in the SPY update, and then there's the wave 5. If we break below 320, we come down there. And I would submit that is highly likely to occur no matter what happens in the SPY or the Dow. Just because of the fact that what is going on with the small caps. You can see that we have this big sideways channel here. And we talked about how the channel had been a low of 210 and a high of 230 for all of, except for minor exceptions, all of 2021. And now it looks like for 2022, all we're doing is coming down here and lowering the range 20 points, but we still have the same 20-point range between lows and highs. So instead of 210 to 230, we're 190 to 210. And that's still staying the same way. With the move down yesterday, got down near 190. If we break 190, we're very interested in putting on a bearish trade on the IWM, but we got to break 190. Now you can see why. In addition to looking at the Elliott wave pattern here, breaking below there to come down and hit this wave 5 target, we got to get below that 190 level. So that's for the Elliott wave impulse pattern, in addition to the fact that we're churning in this trading range. So you have two different reasons there that 190 should be broken if you're going to go short. If you wanted to go long, well, you wanted to wait for a break above 210. If you can break above 210, then you can consider a long on the IWM, but I wouldn't do it now, again, because of the trading range. But really interesting, isn't it? Although staying within a range. It's pretty interesting as well. You can see that boom, up, back down, and now we're getting a little bit of a triangle formation here. So one could kind of argue that, is that symmetrical, a symmetrical triangle here, or is this a descending triangle? And in the end, it doesn't really matter whether or not it's symmetrical or descending. Triangles are triangles. They're consolidation patterns. And as long as there's one of those triangles, we like those patterns. But the key again here is 36,000 is what needs to hold on Bitcoin. So far it's doing that. Can it continue to do it? Well, we've got a pretty strong wave 4 here at that 38.2% fib level again, just like the Qs. And we've tested it. started to move back down, but so far 36,000 is held. If that gets broken, then you have a whole different scenario. And here's the ADX. It's one of the indicators in the DMI, if the DMI is new to you. The ADX measures the strength of a trend. Now, just because you have a low ADX doesn't mean that you're in a triangle. It just means it's consolidating. It could be going dead sideways. And with the ADX being lower, telling you you've been consolidating for a while, it's likely to break out sooner rather than later. So here we have awfully close to 100 on the dollar. I think we get there. In fact, the Elliott wave pattern now is showing us 102. So it's relabeled because that 5 relabeled to a 3. I shared that in the last SPY update on our YouTube channel. And look at this triangle. Now there's a nice little triangle. Elliott would be really proud of that one. Small little triangle there, but well formed. See how it's touching multiple times on the upper trend line and the lower trend line? Those are the kind of formations I like when it comes to triangles. So looking really good there. So which way do we break? I don't know. You don't know. Elliott would say it's a wave 3 to the upside. You're likely to break to the upside. And that's where I say, okay, Mr. Elliott certainly has his opinion and created a heck of a technical analysis system. But it's been my experience that when you see a triangle, you have to respect either direction. I would be surprised if the dollar broke down, but the market surprised me before. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.